Hey, good afternoon, ladies and gentlemen. Very warm welcome to the weekly market review for the 15th of May. My name is Benjamin Good here, Research and Investor Education here at SIAS. Alongside, we do also have Sunny So, our Senior Technical Analyst, who will be covering some of the topics, highlights for the week. Before we get there, let's talk about the disclaimer. So SIAS, as you should already know, is a registered charity. We're not licensed by MES. So whatever that we talk about today, especially for specific stocks, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. A couple of admin matters. We do have the upcoming SIAS event. This is for members only on the 21st of June, or Wednesday. 21st of June, Wednesday, which is at 7 p.m. This is the QR code. And we do have, for those of you who are still not members, you can join us at $1 a month. That's $12 per year. Again, the QR code here. And of course, the main benefit of joining the SIAS membership is to be able to join our weekly, not weekly, but monthly SIAS session. Okay, now this is something that we talked about last week. Again, the projections for the CPI, globally speaking, points to the fact that inflation is going to be relatively stubborn. In the US, this is mainly driven by wage inflation, as in the US unemployment rate is still at a historic low of 3.4%, with a slight expansion in the participation rate. But generally speaking, is a very hot labor market in the US. That, in conjunction with the high cost of rent, as well as things like some particular products, that is why the CPI in the US is relatively stubborn, and it's going to take right up to the end of 2024 to hit somewhere around where they want to be. But that said, nobody's going to be hitting a 2% CPI except for China, as well as some other advanced economies. So China have got their own issues, mainly it's a growth issue, not so much as an inflation issue. But as you can see, the white color line here, the emerging markets, ex-China, we're going to be seeing relatively high CPI heading until the end of 2024. Now, the turn or the moderation in the CPI numbers, especially in the US, has got a major benefit to the S&P 500. So as you can see, this is the comparison between the CPI, which is the orange color line, as well as the S&P 500 forward, or rather the 12 months forward operating margins, right, excluding financials, real estate, and so on and so forth. Simply because those sectors are generally a little bit more volatile. But if you look at the other sectors, this is a consolidated line here, the white color line. There is actually a nice improvement in the 12 months forward operating margin. This is forecast, so 12 months forecast, simply because the US CPI has come down quite nicely from a peak of 9.1% in 2022. So now the CPI is low enough for the forward 12 months operating margins to stage a U-turn. Now, this is key simply because margins tend to push, or rather when margins improve, it tends to improve the earnings per share, which would then improve the price per share. Right, so there are relatively high correlation between all these three different matrices. So it is nice to see that we have staged a U-turn. Now, obviously, there are a couple of risk factors out there, which Sunny is going to talk about, one of which would be the debt ceiling, and then the second thing would be the ever-blazing embers of the financial crisis, or rather the crisis in the banking sector in the US. So that's can't be discounted. But based on the pure economics of it, it looks as though we'll be heading into a much better place when we start 2024. Okay, Now, this is a chart that shows why operating margins are expanding. So we are comparing between the CPI year-on-year change versus the PPI year-on-year change. So this is basically just a straight difference, all right? Now, the PPI is the Purchasing Price Index. That means this is the general price levels for goods and services which companies need to buy in order to make products or services. So obviously you want to see a spread, right? So CPI is in general what people pay, therefore what the companies charge. PPI is what the companies pay for the overall material. So the difference between what the companies charge and what they pay is, of course, in very general terms, that will be your margin. So on a very broad aggregate macro level, we can see that in the US, there is a positive spread between the white color line, the CPI, the white color line is basically the spread already. So you can see that the spread is moving up, or has moved up into positive territory. And then you can also see that that has made a difference in the S&P 500 12 months for operating margin. Already we kind of know the drivers of the PPI. So you have got commodity prices, which are on a, depending on which sector, but energy itself is not heading towards the relatively high apocalyptic level of $100 or $120 per barrel. It's actually moving down, fears of a global slowdown. So that's kind of nice. Then, of course, the soft commodities is kind of stabilizing, again, depending on what kind of soft commodities. From its peak in 2022. So all those are basically providing a tailwind into the reduction in the PPI. So this bodes well for companies in the US. The last thing I want to talk about is basically the China as well as emerging markets. So saw an article over the weekend. This is again by Bloomberg. JP Morgan back in 2021 or was it 2022 made a huge stir when they said that China was uninvestable. A bit of a background story. So it was a bit of a snafu because they wanted to scrub out the word uninvestable, but they didn't get to all of the mentions in the article. I don't know, they can just use a, Control H, right? Find and replace the word. I don't know why they can't do that. But the word uninvestable went out in the research report, and of course, it caused quite a big of stir. In the end, about $200 million, or was it $1 billion, of market cap evaporated both in the US as well as Asian markets. All right. So China is back simply because they are now continuing to make a stir. As of last week, we've had news coming out that kind of suggested China is using a new securities law, anti-espionage law, to kind of clamp down on consultants as well as, basically consultants that hedge funds as well as market participants use to try and find out what's happening in China. So just to be clear, in most other cases in the world, these kind of consultants are known as expert networks. So it's just like paying an expert in AI or a professor to give some opinion about whether NVIDIA is doing well. So it's not really espionage as, considered espionage in most of the world, but in China, things are obviously different. So as I say in French, this is 两码事. All right, so they've started climbing down on all these consultancies. Apparently, some people have already been taken into custody. Separately, but related to that, again, China has locked down on some information flow outside China. So if you're outside China, you are not going to get access to certain types of information which you used to get. So things like manufacturing information, things like output, so on and so forth. You might not get it. So which means that China is again becoming more and more of a black box. So that is leading to all these problems here for research analysts. So the percentage of negative earnings revision, that means you have an analyst report that revises the earnings down. So that's what you call negative earnings revision. And of course, you've got a positive earnings revision. That means you've got a re-rating. So analysts are actually, revising the earnings upwards. So the percentage of negative earnings revisions continue to outpace the positive ones. As you can see somewhere on the right-hand side of the chart, you have got the orange color line, which is specifically for China. and I think that mark is somewhere close to the minus 40%, meaning that there are 40% more negative earnings revision compared to positive ones. So there is a problem here because empirically speaking, this percentage of negative earnings revision outpacing positive ones, there is actually it actually has got a correlation of 0.6 or 60% between earnings revision as well as the PE ratio, and of course PE ratio is tied to price per share. So the challenge here is that on the earnings front, on the fundamental analysis front, picture doesn't look good. Trend is still downwards, and of course with the new anti-espionage law, that's not actually helping things. The same can be said of the overall emerging markets, and you know, so in general, not really that good an idea to invest in this region. So when the U-turn starts, markets, you know, improving after the recession is over, the bet is probably going to be the US and some parts of Europe. Okay, so I'm going to end here. Sunny will take over and talk about the Fed funds policies.
Okay, so do allow me to share my screen. This is the one. Okay, I'll just go into details on the data that was published last week, because the all-important data, the inflation data, as well as the PPI data, and of course the consumer sentiment data that came out last week. So the headline numbers coming out, inflation rate month on month, the actual number was actually 0.4 against the previous 0.1. So this number is actually quite in line with the consensus. But then this announcement, which was on Wednesday, 8:30 before the market opened, the headline inflation number 4.9% versus the previous 5% and the consensus of 5% is 0.1% lower. And that's why you see the big jump in the market during the pre-market of on Wednesday. But then at the end of the day, when market closes, the market was more or less flat. And that's also explained why the past 2 weeks has been a down week for both of the major indices. Now, the core inflation data also dropped by 0.1%, and then the previous reading was 5.6%. This reading is in line with the market consensus for what market is expecting. So overall, if you read in totality, all this data, inflation data that come out on Wednesday, basically we just moved the needle only a very little bit, and we are still very far away from the 2% target inflation rate that the Fed is looking out for. So I wouldn't read too much into this data. Is that the inflation rate is coming down and will likely going to stay down. But I would rather read this data as inflation is going to stay very sticky going forward, and hence it's not going to come down as fast as some of the market participants or analysts may be expecting. Why is that so? Because on Thursday itself, when the PPI data came out, it actually grew by 0.2% compared to a negative 0.4% the previous month, and consensus was 0.3%. So PPI is much more of a forward-looking kind of an inflation gauge, where the producer's price will eventually be passed on to the consumer, which would then be reflected in the inflation rate data. So a positive reading on the PPI numbers compared to a negative reading in the previous month will actually mean that eventually, if the cost passed on to the consumers, we have a very sticky inflation kind of environment still. The market is still facing right now. So inflation is unlikely going to come down very fast, very soon, and hence the need for the Fed to maintain a high interest rate, or maybe even continue to hike the interest rate, is a very real possibility. And on Friday itself, the consumer sentiment data came out, which has a big miss from the 63.5 as well as the 63 level of consensus reading, coming at 57.7, also double down on the market sentiment that recession might not be as light as what the Fed might have said, and might be even more steep and more heavy. So if you look at the CME Fed Watch Tool, which calculate the target Fed fund rates based on the target FOMC rate based on the Fed fund pricings, you can see that the next meeting date is on 14th of June, and over the past few weeks or even months, you can see that there's a downtrend of a sort of a maintain in the rate percentage of between 5 to 5.25%. Now the probability came down from about 1 week ago, which reached at 91.51% to yesterday at 84.49 to what we see today at 81.72. This means that the probability of a no rate hike for the June meeting is on a downtrend and is coming down, whereas another 25 basis point hike for the June meeting is also creeping up from 1 week ago at 8.49% to 15.51 to what we see today at 18.28%. So do take note of this data and keep a close eye on it. I believe the door to another rate hike of 25 basis points for the June meeting is not really extinguished yet and may likely have a surprise on the market, which largely is expecting a no rate hike kind of situation, which have been talking about that if the Fed were to pause the interest rate hike, market is likely going to rally. But then when is this coming? That's the big question mark. And this is the probabilities that we've seen in the market right now, or what the market is expecting right now. On the earnings side, this week is all about the major retailers. Okay, we have the Home Depot reporting their earnings on Tuesday, and of course Wednesday we have a Target, and then Thursday we have Walmart. So all these major retailers will give an insight into how the retail spending is going to be like, and how if the consumers are still buying in or tightening their purse, and that will also give us an indication of when are we going to go into the recession and how deep the recession is going to be based on the guidance provided by these major retailers coming in this week. So for now, I will just go into the indices to see how the data that we saw last week has impacted the market. So as you can see, for the past 2 weeks, Dow Jones Index has been on a downtrend already. We have sort of formed a triple top formation, which is a bearish kind of a technical charts formation, which means that market is likely going to come down, and this level, the red line over here with the triple top that you saw this year at 34,281 will likely be a very strong resistance going forward towards the end of the year for the Dow Jones Index. So you can see that the recent movement also quite a distance away from this resistance level that you see. That means this resistance level is very much intact. So where is the Dow Jones likely going to hit in the next few weeks? I think on the near-term side, if you connect the low of the October as well as the low in the March this year, you get a sort of an uptrend line, which I indicate here in green, that could provide some kind of a support for the Dow Jones Index going forward. And this support is likely going to come in around the level over here, I believe, around 32,525 point level. If you look at the indicators on the Dow Jones Index, definitely the MACD line and the signal line is on a downtrend. We have a negative 76.22 reading, and the MACD histogram is below the zero baseline. So definitely a lot of a negative momentum in the Dow Jones Index right now, and we are not seeing any kind of a reversal from the MACD indicator. On the RSI indicator, as you can see, the latest reading on Friday is 45.99. That's below the 50-point neutral mark for the RSI indicator, which also means that the momentum now is very weak in the Dow Jones Index. It is also below the 14 days RSI-based moving average reading at 51.40. And if you've taken into a whole since the peak that we saw on the 1st of May, RSI generally has been in a trending down direction and still a bit of a distance away from the oversold signal of a 30-point reading on the RSI. So we expect the Dow Jones Index, according to the indicators as well as the chart formation, to likely continue the downtrend that we see in the past 2 weeks, probably for another 2 weeks before we find some kind of a support or stabilization around the 32,525 point level. Okay, so next I'll move to the S&P 500. S&P 500, the prominent chart pattern that we see on the S&P 500 would definitely be the double top formation that you see here, which is on the high of February as well as the high in May. So this double top formation would then be a bearish kind of formation for the S&P 500 index. And the S&P 500 having closed last Friday at around the 4,124 points level is actually trying to sit on a double top formation that was formed in December last year, using this as a support. However, this support is used to be a resistance level. So that could sort of say that it's not likely going to be a very strong support for the S&P 500. Why do I say that? Because if you look at the indicators, histogram is MACD histogram is negative 3.66, and the trajectory of the MACD line as well as line looks to be coming down further. On the RSI indicator, the RSI reading is just slightly above the 50-point neutral mark, reading at 52.57, and it is still coming down. and it's still below the 14 days moving average on the RSI at 53.11. So it's more or less RSI is looking to me as a neutral or even going to trend downwards further into the next few weeks. So where is support likely going to come in for the S&P 500? Of course, we have the exponential moving average line over here. The prominent one will be the 200 days EMA line, which is signifies in red. So that will provide the first level of support. If we break that, then definitely this uptrend line connecting the low in October as well as March this year will provide further support for the S&P 500 around the 4,000 handle or just slightly below around the 3,950 point level. That is where support is likely to come in for the S&P 500. Now, with the economic data and the earnings calendar or the earnings season going into the second half or even ending soon, we see that there is limited catalyst on the major indices on the US market. Hence, most of the US indices are going into a consolidation or a downtrend mode because of the lack of catalyst. Next, let's move to the Nasdaq Composite Index. We can see that Nasdaq Composite Index actually managed to breach above the double top formation that was formed on the high of January as well as the high in May. However, this breakthrough that we have last week, is this a false breakout? That awaits to be seen. And this level that we see over here is actually not only a double top, it's also one of the top that was formed in September last year as well. So if you look at the technical indicators, the MACD reading is now at 12.14. So a positive reading. There may still be a bit more of an uptrend on the MACD as according to the MACD indicator, as long as it stays above the zero baseline. On the RSI indicator, the reading at 58 is also 8 points above the 50-point neutral mark, which means that there's some positive momentum still present in the Nasdaq Composite Index, and it's also above the 14 days moving average of 54.79. So for the Nasdaq Composite Index, I think it still has some leg to run. However, the next resistance level, since we have surpassed this double top formation for this year, the next resistance level would be around the 12,555 point level. And that was a double bottom formation that you see during the March period last year, which could have a change in polarity to become a resistance level in the near term in the next few weeks for the Nasdaq Composite Index. So I believe Nasdaq Index still has some legs to go to retest the 12,500 level before we find a consolidation, either using this double top as a support going forward or even the December double top as a support, which is much more strengthened by the moving average that you see over here, and of course the uptrend line that you see connecting the December low as well as the March low this year, which will have very strong support for the Nasdaq Composite Index should it have a sort of a pullback or a reversal in the short term. Next, I'll move to our local STI index. STI index, you can see a very steep drop for the past 1 month or so, because led by the drop in the banking counters in Singapore. So where's STI likely going to hit? Of course, we are going to hit to look for some support. This downtrend line is actually pretty strong. We can see that if I zoom in to read the moving averages, the EMA line, the 20 days moving average, which is the green color line, has actually cut below the 50 days EMA line, which is in blue. So that is the short-term change in trend indication. So you can see the downtrend occurs earlier, and the EMA line or the moving average line is always a lagging indicator, but that is a confirmation that we are going into the downtrend. According to the MACD indicator at negative 10.52 and the divergence of the MACD line away from the signal line below the zero baseline, this downtrend do have some momentum, pretty strong momentum in it, and it's likely going to trend lower in the next few weeks. The RSI indicator at 30.71, okay, so that means very weak momentum. However, we are very close to the 30-point trigger, which is the oversold signal. Thereby, it could trigger a reversal once it goes below that. So if I'm going to look back into how low the RSI can go for the STI, the most recent reading that was in March low this year, the RSI actually went to the reading of 22.06 on 14th of March. So I would not be surprised if STI go to reach the 20-point level in the RSI as indicated earlier before it sees a rebound on the support line that you see over here, which is connecting the low of October as well as March this year. And that's around the level of the 3,150 points level. And that would be a key support for the STI to hold. Should it want to continue on the uptrend that you see over here on this green color line. Next, I'll look at SIMSKI. Okay, so the SIMSKI index, as you can see over here, is on a downtrend for the past 1 month or so, I would say. However, it is now using the all-important $300 handle, which is a double top or even a triple top formation that we see in December. And this has become a pivot line more or less for this year SIMSKI index movement. Okay, so the moving averages is also providing a strong support for the SIMSKI index. You can see that the red color 200 days EMA line at the reading of 300.4. The SIMSKI reading now at 300.3 is using this as a critical support should it want to sort of give a break to this downtrend that we are seeing right now. However, on the indicator side, the MACD histogram has turned negative. Now it's at negative 0.5 below the zero baseline. So negative momentum. MACD is telling us SIMSKI is likely going to go down further. RSI is at 42.3 below the 50-point neutral mark and below the 14 days average of 46.82. So very weak momentum in the SIMSKI index right now. So SIMSKI is likely going to go down further and support is likely going to be seen over the green line here. And that is the support that you see that in March last year at the level of 292.3, which also was it may have been breached in the March period to reach a low of 286.1, but then this is the first level support. But then if the sentiment turns worse or the MACD and the RSI indicator hits lower, it is a very high possibility that we are going to test the 286-point level, which is year-to-date low for this year 2023. So that is my take this week on the data as well as the technical analysis on the major indices. Any comments, Benjamin?
No, I think that's great. So thank you very much for that. So we're going to end today's video. Thank you very much for joining us this afternoon. So have a great week ahead.